All right, welcome to 18.1 Work Together, where we're doing our short-term debt financing. So when you look at 18.1 Work Together, you're going to see we're going to have four transactions here. One having to deal with a line of credit, and the other one having to do with an extension of a note. So our first one on March 3rd here is that we drew $6,500 on our line of credit. So in this situation, remember the line of credit is a form of short-term debt financing where you get immediate cash. So that's actually going to go in our cash receipts journal. So we go down here, we put in March 3rd. Our account title is whatever is going to be credited here because obviously we're getting cash, so cash is going to go in our cash debit. The account title again is our line of credit. Our document number is receipt 146. And that's getting credited for the entire amount that we withdrew, which was $6,500. And cash obviously is going up for $6,500. Okay, very similar. If you need to look back and reference it in our PowerPoint, this was the one where I talked about drawing on a line of credit on slide number 6. Okay, moving onward, on March 26th, we signed a 90-day 10% note to MVD Supply for an extension of time on our account payable. So this is where we owed MVT Supply $2,400, but we needed a little more time to make that payment. Notice that it's a memorandum. That's usually a good giveaway that it's going to be in our general journal. So we're going to go down to our general journal here, and we're going to put in our date, which is March 26th. The account that's getting debited is the liability account that is going down. Remember, in this situation, we're just swapping a liability for a liability. So the one that's going down is actually accounts payable / MVT Supply. Then let's add our document number, which is M92. And then the amount of that transaction is $2,400. Then the amount that's getting, or I should say the account that's getting credited is our notes payable. So remember, we're taking it out of accounts payable and putting it into our notes payable account. Okay, so that one is the one that's going to be credited. Just switching one liability for another liability. Okay, again, if you need to see what that looks like, go back to the PowerPoint, and it is the one on slide number 8, signing a promissory note for an extension of time. So then in June here, we're actually going to be paying our maturity value. So let's talk about the one on June 24th first, which says that we paid cash for the maturity value of the March 26th note, the principal of $2,400 plus the interest. So let's put our date in here first of June 24th. And our account title is going to be, the first one is notes payable, because that's what we're paying off, our notes payable. And then we also have our interest expense. Okay. Don't forget to put your check number in here, which is check number 362. You don't have to put the C because it already is a check. And then what we need to do is do a little figuring. Okay, so our notes payable amount was $2,400. So that's our principal value that we're paying off, the $2,400. The next thing we have to do is calculate that interest expense. So this is where I know some of us have had troubles in the past. So we have to think about when we go back up here, we signed the note on March 26th, okay? So on March 26th, we sign the note, and then we have to figure out how many days are left in March. Well, March has 31, so if you take 31 minus 26, you get 5. Okay, so we've got 5 days in March. Then we have April, which has 30 days. May has 31. And then we pay it on June 24th, so that's 24. If you add all of those up, we end up with 90. So then we use the same formula we found over here. Okay, we take our principal amount, which is 24, the interest rate of 10%, 90 divided by 360. And remember, we talked about that 360 in accounting 1. That just accounts for the 5 major holidays where the bank is not open. And when we do that, our interest should end up being $60 if you do that calculation correctly. If it helps for you to maybe write down in order to find your interest, you could certainly do that. It wouldn't necessarily be a bad thing to write that out on paper in order to figure that out. So then the total cash credit when we pay off both the note payable and our interest then is $24.60. So that's how we do the June 24th one. The last one is that we paid cash for our monthly payment on our line of credit, which is the principal balance of $1,500 and then our interest of $64.20. So they actually give us the interest on this one, so this one's pretty easy. We go to our cash payments journal and we plug in just 30. And what's going down is our line of credit. With check number 369. Our principal balance was $1,500. Then we also have interest expense of $64.20, which means that our total cash credit is $1,564.20. So those are our 4 transactions that we did that relate to short-term debt financing. If you have any questions when you're going through it, again, your PowerPoint is a great resource. You may also need to use your book, but feel free to move on to the 18.1 on your own.